I'm going to the city and I'm gonna do a city show. And I know all my fans wanna learn how to make some dough. I've been cruising up and down for trades each and every night. And with my iPhone reclining, I know we're gonna get it just right. I'll get inside your mind, we'll have a real good time. We're gonna trade today, we gotta trade today. Go askSlim.
Hi, I'm Steve Miller. Call me Slim. And this is the askSlim Market Week. It's a look back at what happened in the financial markets in the past week, and a look forward at what might happen in coming weeks, and hopefully lots of great ideas and opportunities for you throughout this show. Well, the stock market spent the early part of the week stuck in the same narrow range it was in the previous week. Monday, markets moved up early as China indicated it was going to take the pressure off their tech stocks. Didi, which is their rideshare app, got a little life back when they said they would allow that app to come back soon. And the China ADRs, they moved up sharply. Of course, pulling back as the markets pull back now, we kind of think that those are some stocks you can look at to buy the dip. Amazon had its 20-for-1 split and also moved to the upside, and that helped markets move up early, but then on Monday the markets faded and ended up with small gains still in that range. Tuesday was a whipsaw day as Target cut guidance. They have a huge inventory build, and the consumer is softer, as they indicated, and the stock was down 8% pre-market. You know, this is a result of that male investment. You used to hear Ron Paul talk about that all the time, one of my heroes, and he was very clear that as the government puts all this funny money into the stimulus, then money gets invested in ways that, well, are not really smart. And what happens, of course, is that in this case, the consumer got flush with money because the government gave them so much. And now that they've pulled the plug on that, well, the consumer is pulling back sharply. And of course, the inflation is killing them also. So these inventories are building, and that had Target down, well, 8% early. But then Kohl's moves up 12% as they're in talks to be bought by Franchise Group. So that was a big whipsaw day. And the S&P actually was able to manage gains of 40 points. Wednesday, the stable market was interrupted by a report that the SEC chair, Gensler, asked staff to route orders directly to the auction market. So that was essentially bypassing the companies that get paid for order flow. They proposing now that, you know, everyone can trade in fractions of a cent. They want to make it more fair and remove that advantage that, well, those big traders, the big companies, and those high-frequency traders have had for so many years. And if they do that, of course, that means they're trying to end pay for order flow. And Robinhood just fell so hard. Now, brokers collapsed right with it, and the S&P 500 moved down $50 fast. I always actually did think that that was unfair, but it does make for deeper markets, as there are so many people trading within those pennies in stocks. And if they kill that, then volumes are going to go down very significantly, and volatility is going to go up. Now, for some, that might be great for traders, but it's really not great for investors, and retail will then have bigger slippage. Less slippage when they trade, so it's kind of good for them. But the brokers then lose a lot of income, and that's why you had those big declines. And Robinhood is already down 90% from its ridiculous high when that issuance came. Thursday, well, ECB set their plan for rate increases, but they're brutally slow, and Lagarde is just plainly one of the worst. What we saw happen is that yields moved up that day over 3.05%, and mortgages moving up to an average of 5.23%, and that scared investors. That brought the stocks down to the bottom of that range that they were in, and then it broke the range, and then sellers came in like crazy, and the S&P 500 ended down 98 points on Thursday, the Dow down 638 points, and the transports at that point had a 2-day decline of 6%. So the stocks got sold very hard on Thursday when that range got broken on the downside, and that was kind of set by ECB setting their plan, but really the market was ready to have some pullback. Friday, well, the CPI came out, and those numbers were much hotter than expected. 1% for the month. The core were up about 0.6%, and the headline number year over year up 8.6%. That's a 41-year high. The S&P 500 immediately fell. It was down 60 points pre-opening. It got as bad as down 115. That's where it is right now as I am doing this show here around midday. The TNX, that's the 10-year yields moving up sharply. TYX, the same thing. And that yield curve, again, is inverting. And that has the investors extremely scared. And when they see that, they just plain puke. And that's what they're going on right now. And these rally illusions that they had are really disappearing. That's what's going on. That's putting pressure on the oil market. But with the higher yields here, the dollar is soaring, both in a flight to safety and that the U.S. dollar has appeal, or dollar-denominated bonds, for all over the world, because the dollar is strong and yields are high. So compare yields to Japan or other places like Europe. The U.S. yields are just extraordinarily high, and that brings money here. And at the same time, it shows you how far behind the curve these other countries are. And that's really an important discussion regarding how long this period of central bank correction or tightness is going to go on. So we talked a lot about earlier in the year about the negative market conditions, and we showed that analysis for 2022, looking at high yields, HYG. These are the corporate yields, and we were looking at correlations at that time and forecasting that the peak in high yields was there, and it was likely to bring the stock market down with it. I want to look at that again because we had expected this big decline in high yields and also in the stock market. And let's just review that for a second. You get an idea where we are right now. So this is that chart that I shared. This is high yield versus the S&P 500. Comparative cycle analysis. And plainly, when the government stimulus is there, it helps corporations, especially the very weak ones, and earnings become inflated. You get real low interest rates, their borrowing costs are much lower, their earnings go up, and the rest of the economy is stimulated, so there's more retail, there's more business, and earnings become inflated by that. That's that malinvestment that we talk about. When you have a withdrawal stimulus, earnings are hurt. It puts weak companies, that's those zombies, which are loaded in the Russell, at risk. And you come to some earnings reality. That's really where we are right now. So here's that period right in here in 2020 where that pandemic rebound came, and it was very strong on Fed and government stimulus right in here as you got that big jump over here. So you have here the high yields. This is HYG, as you can see on the candlestick chart. And this is the S&P 500, the line chart right over here. And generally, they follow each other. And we had this big saucer top right over here. We've had other ones in the past that were really helpful to see. And then when this began to roll over, there was trouble. You can see in here on the bottom are our cycle brackets. This is just a drawing tool, a guide for the rhythms that we see here in the market. You could see how closely that follows. This little rally was this rising phase right over here, and then it broke down. That was really ugly. And this is that post-pandemic decline, very weak on Fed and government withdrawal of stimulus and higher rates and QT. This is the whole time period where those zombie companies have to pay more money to borrow, and their earnings are going to come down because the Fed isn't pumping the consumer anymore and pouring money into the coffers, into their bank accounts, and they're all pulling back, and the savings rate has absolutely plunged. and now moving down. You can see actually a few weeks ago there was a good attempt at a rally there, but now giving that all up. What's important in here is this cycle right in here is expected to trough in August or September right over here. And this says that that stock market rebound that happened right in there and is now coming down is likely to continue out into this period right over here in this August-September timeframe. And that's what we've been looking for and showing, and I'll show you that at the end of the show also as we look at the analysis on the S&P 500, that this is really the timing over here. We expect that HYG, the high yield corporates, and the stock market, the S&P 500, and all the indexes will continue to move down very sharply into this period over here, into that August, September, and potentially out into October. So I wanted to review that for you. This is a great guide that you can see, and that is really looking at these high yields. As we continue to expect, with some upside attempts, that we'll have much lower stock prices, and that's likely to happen into the fall. However, the last quarter of the year could be better. You see in here where that bottom is supposed to come, that trough in there, and you could get a rally. That'll be another time where investors' illusions of the stock market moving to all-time highs again, they come up, and investors will, of course, be buying, and we think that will happen. But the central banks have a ton of catching up to do, and we think that'll come way out into 2023. Bank of Japan, the ECB, all of them are way behind, and there's going to be rate increases well into that time frame, and a lot of discussion about that really being the recessionary time out into 2023. So we think that rates are going to continue to go up into that time frame. The stock market will continue to be weak, and we will continue, even though we see a good last quarter to the year, to be in a bear market well into 2023. So for the week, the stock market has had a pretty big downside turn here at the end of the week. Major index is down about 5%. It all happens Thursday and Friday, and we get the Dow Jones Transportation Average down about 7%. So that's really getting hammered. The 30s, 30 years, they're down about 2 3/4 points, closer to 3 right now, and the 10 years up around very close to 20 basis points. That is a surge in interest rates, up to about 3.15 and very near that high, 3.15%. Gold up about $8 and looking very resilient, if you ask me. Watch Future Speak on Wednesday, and you'll get all of our 24 different futures contracts and the indexes, the analysis on that on the weekly and daily charts. Arvi does a just amazing job on that. We'll show you a little preview of that in just a moment. Silver for the market, slightly lower, but also acting pretty resilient in a time when yields are popping up very significantly. For the dollar, it surges. It's up about 1.7%. It's in a tough spot. This is some resistances that we've shown in here. It's likely to test and fail, and we're saying that based on what we think is a bottoming going on in the euro, which is inversely correlated. And I wouldn't be a bit surprised to see the euro begin to pick up its head and the dollar begin to move down again, maybe as early as next week. Oil, well, it was really a small, the patterns are really bullish. Small moves this week. It has, in our opinion, based on the analysis, a shot at 126. It got through the 116 resistance, got up to our next one at about 122. Small pullback of less than $2 today in the oil market, and with just this small change for the week, and the bond market getting hammered, I kind of think that we're going to get that move up to 126. So watch Future Speak, and you'll be able to see that analysis. Also, remember, Future Speak is for our level 2, 3, and 4 members. Coming up in this show, Arvi is going to give you that preview in Future Speak, and he's going to show you the 10-year yield chart, TNX, which is now moving up sharply. We're going to look at some multiple time frame analysis that Katie is going to present, looking at Tesla. And Matt's going to give you a preview on our SIR live stream, of which is just amazing for short-term traders. So it's important for you to watch that. And I'm going to give you a pretty deep look at the stock market, and I'm going to show you our SIR live stream, live actually, and you'll be able to see the value of that for short-term traders. So I think it's going to be great information for you going forward, as we always do. Remember this chart, high yields versus S&P 500, and that's talking about the stock market decline out into the fall. Go to askSlim.com, subscribe to that website. Make sure you share it and follow us everywhere that you can. If you're new, you could become a free member, or you could take advantage of one of our specials. On YouTube, do subscribe to the channel, click that notification bell, and like that video. Give us a thumbs up. On Twitter, follow us at askSlim. For any questions about our memberships or our huge offerings of education and analysis, do write to Matt at askSlim.com. He always has a special for first timers, so write to him. All right, this is a member video. This is a preview of our Future Speak show, and Arby is showing you the analysis on 10-year yields. And I think you're going to find this quite interesting. He was talking about the potential for yields to go higher, and you will see that in this video.
So this is TNX, and this is really very important. So in the opener, we highlighted that the bond market is getting into a very risky period here, and it's really having us look at that older ghosted cycle now that we have on the futures as what could be the actual dominant cycle and would really be a much more negative situation. Let's see how that shows up on this chart right here. So what we're looking at and what we've been highlighting is that there was a key bottom that was due here in the 10-year yield market with the low that was due 425 to 530. What you'll see is that this formed a flag into this rising 13-week simple moving average in black, and then has now turned back up on the upside. So we are in the early stages of this rising phase here on the weekly in the yields. What we're looking at is two cases. Our overall base case was for more of a range here in the yield market, and then for a retest of the old highs around the 3.17% level here in the 10-year yield. What we're now looking at is the possibility that we actually move through that old high and then get up into these higher levels here, which come in from around this 340 to 346 area here on the upside, which is this green track right here. So very important time period as we are early in this rising phase here in yields to see how it can do in this rising phase. It'll tell us if it can get through this prior high at 3167 and then really stay above that. It'll say that 34 to 3460 is really the next upside target here in the yield market. Let's go ahead and shift over to the daily chart. Now, we have two out-of-phase cycles here in the 10-year yield, as we had both of these coming into a period where they were due to form lows. We would call this a nesting period. And then we got into the rising phase on both of these cycles right here. Let's zoom in a bit. So we are in the rising phase on both of these out-of-phase cycles, and now looking at a key zone. Our base case was really drawn in black, where we would have looked for this to then pull back into this next key timing low on this black cycle, which is due around the end of June. But what we're looking at is now this green track, where we actually get through the 78.6 at 3073 and then get up into this prior high here at 3167, which is this green track. If that were to happen, it would say that the bear case in bonds is really very much in play. So very important to see, can we get through the 78.6 in yields? If so, we'd be looking for a move at the very least in the short term to the prior swing high here at 3167 in the 10-year yield market. So very interesting pattern here, and really setting up much more bearishly than what we had originally forecasted here in yields, which was already a really more bearish forecast.
Great job, Aubrey. That really is in alignment with what we're seeing here with yields moving up. All right, there's so much interest in Tesla, and Katie does just an amazing job on this, highlighting our cycle low timing tracker, which is just something that's fantastic for people that are very interested in looking at what happens in cycle analysis around the time that you get to market troughs, where those lows are supposed to come and where there's a very high risk period, and when the markets are proving that they're ready to go back up. So this is really important. She's going to look at the weekly and daily in Tesla, and I think you're going to love it.
Hi, I'm Katie with askSlim. Let's take a look at the Cycle Low Timing Tracker. This is a recently developed tool for our Level 3 and 4 members. Its purpose is to call attention to opportunities that may be setting up both going into and coming out of cycle lows. Today I want to focus on this section here. Generally speaking, symbols that appear in this box are expected to show weakness, maybe even breakdowns in their current daily cycles, because those daily cycles correspond to a period of time on the longer intermediate term time frame when we're expecting weakness and for lows to form. So one of the symbols in this box right now is Tesla. Let's take a look at the chart of Tesla. This is a 10-year weekly chart of Tesla. We have cycle brackets on the bottom that show an average cycle length of 24 weeks, with the purple spikes showing where the actual cycle lows occurred relative to the average. The blue vertical dashed lines over here show a period of time around the ideal cycle bottom when we expect the current cycle to form a low and start moving up into the next intermediate term cycle. And that period of time for Tesla is between June 27th and August 5th. One other feature of our askSlim weekly charts is our proprietary momentum indicator, the Reversal Scout. This green and purple ribbon on the chart, green for positive momentum and purple for negative momentum. As you can see, we currently have negative momentum on the Tesla weekly chart. So taking a look at the last couple cycles, this one was basically a sideways consolidation after some good advances in the prior cycles. We made our cycle low right here and then had another strong advance on positive momentum. That area around $1,200 started to give Tesla a little trouble. You can see the Reversal Scout turned negative right here, and the cycle ended up giving back most of that advance. We made our cycle low right here, getting below the 78.6% fib and bouncing back up from that area. So although this is a positively configured cycle, meaning it ends higher than where it began, because we gave up so much of that advance, the probabilities favored not being able to take out that cycle high. We got an upturn in momentum as we began the rising phase of this cycle. Then we made it up to the 78.6% fib of this move from here to here before we rejected from that level. We got a Reversal Scout that turned negative, and then we got this decline that broke through the cycle low support, both the current cycle low support and that of the previous cycle. So then we were able to create a minor resistance zone using the current cycle high and that recent low. If Tesla were able to get up into that zone, we would consider it a good short side opportunity for a decline into this cycle low timing period that I mentioned earlier from June 27th to August 5th. Here is our daily chart of Tesla. Now this one you can see two sets of cycle brackets on the bottom, and that's because we have two out-of-phase cycles at play here that are both showing an influence. So starting right here, you can see both cycles moved up together in their rising phases on negative momentum. Now the daily chart momentum has both the Reversal Scout as well as the slim ribbon, which colors the candles green, gray, or red, depending on the momentum. So even with both cycles pushing up, Tesla was only able to tag the very bottom of this resistance zone at about $950 before turning down and breaking through that cycle low support. Once that happens, probabilities favor declining through the remainder of the cycle, and that's what happened. We reached the bottom of this target zone at the correct timing for the cycle that's represented by this black cycle bracket. And then we moved up into the rising phase of that next cycle, right here. And we've had this small decline as the cycle represented by the blue dash cycle brackets has ended. So now we have that next blue dash cycle in a rising phase and the black cycle peaking and getting ready to start its declining phase. The slim ribbon is still currently showing negative momentum as of today, with the possibility of neutralizing if we can get a little bit more of a move up into this zone. So what we're looking for is maybe a bit more upside into this resistance zone and then a decline into the daily cycle timing window between June 21st and June 30th. Now that date range corresponds with the very earliest part of the cycle timing window from the weekly chart, which is why it's found in the in sync box on the cycle low timing tracker that I showed at the beginning of the segment. Now this period of time out here, when the blue dash cycle as well as the next black cycle bottom also corresponds with that weekly cycle timing window and is likely when we'll get our intermediate term low. But for this cycle, our short-term target levels would be here between this 78.6% fib at 657.39 down to the cycle low support at 620.57. Back on the intermediate time frame, our longer term targets would be down to the bottom of this target zone at 609.38, and then if it gets below that, our next target is down here around this cycle low support level at 539.5, and lower even would be this fib extension at about 461.5. If you'd like to learn more about the cycle low timing tracker and all of the tools that we offer at askSlim, please visit our website, askSlim.com.
All right, great work, Katie, on that. Really, that cycle low timing tracker is spectacular. Coming up, stock market analysis. I'm going to bring you some great stuff here, but Matt's going to introduce you to the SIR live stream. And this is amazing. This is a short video for you to see. And if you're a short-term trader in the indexes, don't miss this. It's really great stuff.
Hello, fellow traders and technical analyst enthusiasts. This is Matt with askSlim. In this brief segment, I'm going to highlight our askSlim SIR Grid Live Daily Chart Stream. This is designed for intraday traders and delivers key insights into primary intraday momentum, key support and resistance areas, and highlights high probability acceleration zones for the S&P 500, NASDAQ 100, and Russell 2000. This proprietary askSlim day trading support service is provided pre-market each market session and is available for our level 2 members. The purpose of technical analysis and technical tools are to help give you an edge, an indication of a higher probability, not a certainty because there are none, of one outcome happening over another. And that is exactly what this service is designed to do for intraday traders. It's to help bring structure and confidence to your trading each day. So this grid is made up of two halves. There's an upside half here, and there's a downside half over here. And this is for the S&P 500, this is for the NASDAQ, and again, the Russell 2000. The upside is focused on identifying the anticipated resistance areas, and those are in light pink and also then in this red color. The downside is focused on identifying the anticipated support areas. That is highlighted in lighter green and then also in darker green. We have also added a custom momentum indicator. We call it our askSlim Reversal Scout, which is used to help identify the likely intraday directional bias, which is the line that shifts from green to purple, and it shifts depending on the intraday momentum condition. Finally, the grid features on both the upside here and on the downside for both of the major indexes when we have identified such areas, what we call anticipated breakout acceleration zones. These yellow shaded areas are breakout acceleration zones where the analysis suggests that the index will fulfill anywhere from 60% to 100% of the zone once the acceleration line is triggered. Like you can see here, once we violated this 4600 level, the SPX pushed through this acceleration zone very quickly. And then again, right here, the NASDAQ did it here. And then we had the Russell do it twice when this happened on Wednesday. Okay, so when the reversal scout is in the direction of the accelerations, the probability of it fulfilling the entire acceleration zone also increases. So what I want to do to finish this off is take a look at key aspects of Wednesday's price action relative to the technical details on the grid. So both the SPX and the NDX uh, opened slightly down, and they tried to rally. And you can see here the lighter pink area is defended really for all three of the indexes against that opening rally that came about 45 minutes in. And then the reversal scout, you can see, turned over and went negative. And when that happens, that is suggesting that that directional bias for that session, when it is negative, is likely going to continue in that direction. So let's see what happened as the day continued. As the SPX and the NDX and the Russell turned over here, they all came into support. And you can see that the support here, which is identified in lighter green, did as it should, where it acted as support as buyers were anticipated to come back in. And there was a minor rally. The rally in the NDX, actually, the decline was a little deeper into that key intraday support zone, where when you get into these darker greens or darker reds, what we anticipate there is that there's going to be a reversal fairly quickly out of there. And we can see that that's what happened in the NDX. And in the SPX, we bounced out of support. However, and this is what's very important when it comes to momentum and directional bias, and this is why this grid is also so helpful, is that the rally occurred. However, the reversal scout, the momentum indicator, which helps us to ascertain directional bias, stayed negative. And when we saw this lower low happen here in the candle, that was a suggestion, as well as if you use other momentum indicators at shorter term time frames, that we are likely to have a reversal back in the dominant direction of the directional bias reversal scout, which was negative at that time. And that's what we saw as we went on to make lower lows for the day, breaking down through, which was initially support through that key support zone into those acceleration zones, and closing then the day in support, and then we had that bounce. So that is typically how the price action works in correlation to the information, the technical details that we provide. Although there are no certainties, our job is to determine the highest probabilities of outcomes, and that's what this grid is designed to do. Okay, that's all I have for today. Remember to go to askSlim.com for more information regarding our premium memberships. This is available for level 2 members and higher, or you can write to me at matt@askSlim.com for special trial offers. We wish all of you great trading.
That's great, Matt. We have so many people that use this analysis and are on our live stream all day long, and I really want to suggest that you take advantage of the special that we have for first-time members or people that are upgrading from our level 1 membership. Become a level 2 member, and you'll be able to get this live stream and so much more. And that includes our 600 video library where you can do a ton of learning. So become a level 2, 3, or 4 member. Write to Matt at askSlim.com and you will get that. And ask for the special link for either level 2, 3, or 4, and you will get this great analysis. All right, stock market analysis, S&P 500, multiple time frame cycle analysis. I'm going to show you some analysis that has changed somewhat this week, and we'll say that last week I showed analysis that was either negative or very negative. And the analysis that was proven was the analysis that was very negative as the markets broke down through supports today. And that caused us to do some downgrades to remove some of the upper tracks in here that were possible if the market wanted to do better. But that certainly is not the case now as the market weakens. I'm also going to show you our SIR live stream for short-term traders, and I think that's going to be just phenomenally interesting for you on how you can stay on the right side of the big moves. So that's what's really important right now. Let's take a look as we look at the S&P 500. Now, what we're looking at back here is back to 2020, up to the peak that we had around December, January of this year. And that was the COVID-19 pandemic bubble. We got a big move up to historic valuations, 200% to GDP. This, of course, was all the responsible of the Federal Reserve and the government. If you didn't watch the beginning of the show, go back and watch the beginning, because I show you a chart of comparing the high yields, HYG, to the S&P 500, and why that illustrates a lot more trouble for the stock market going forward. So this, of course, was a time frame when the high yields were soaring on the upside along with the stock market, because those zombie stocks, or companies, essentially other companies, benefit from the very low interest rates and money being poured into the economy in a ridiculous way, and all that money then gets spent, and you get these bursts in earnings that just are, it's not sustainable. And that's where we are right now, is that plug is being pulled all around the world, especially by our Fed. Now, if I advance this further in here, you can see where we are right now. So this was that period up to those exceptionally high valuations. You can see the head and shoulders that formed in here. Head and shoulders are formed by the cycle analysis. And if you take our cycle analysis workshop, you will then be able to see the information on how these are formed. If you want to see a video that is just free, that's free and explains cycle analysis, go to go to the main page at askSlim.com, go to the tab that says workshops, and go to cycle analysis workshop, and there's a great video in there that you'll be able to really understand more about cycle analysis. So on the bottom here are the cycle brackets. Those are just the guides. It's a drawing tool. You could see the minor cycles right in here, the dominant cycles here. Here's where they both came down to a low right over here, and that brought that big selling when they're both in downward motion. Same thing happened in here, but this was a lot of strength in here, so it wasn't able to have a big decline, but this was lower. So in other words, a lower low gets you a lower low, like we have right now. This is not due to bottom out over here until August, September, potentially October. That's in line with what I showed in the beginning of the show, looking at high yields, HYG. Go back and watch that part of the show. This, you can see right in here, is a big failure that we have going on. And that is, when I look at it here on a close-up on the weekly, you can see that what we're looking at is the, let me just make this a little bit easier to see right here. What we're looking at is the decline right over here on this minor cycle, having already come down to near this 78.6 as it's labeled here. We had some potential upper tracks on some of these, but that now sharply reduces the odds of being able to get back up to the level it was. So 41.75 is likely the highest price that we'll see now, though it might try to get up into this white space a little bit right there. This could turn into just a all-out debacle in here and be breaking these lows, and the market would get sold very hard. This low right over here is scheduled for mid-July. So there's this one in here in mid-July. It's very likely going to be below this level at 3,800. And then the next one way out over here takes you out into that September period. And that's where there's this nested bottom in here in line with the monthly cycles. That likely are significant lows. The timing ranges are synced for all indexes over into this period. So September, October is where they all nest, and that's likely where this first important low for the bear market will be. But you can see in here a possible bear market projection out into February of 2023, plus or minus a few months either way. So there is a ton of risk still out over here. So we expect to get a rally out here after these declines, and this will be that hook where the illusion comes back of a new bull market, and then it begins to move down again into 2023 as the recessionary possibilities increase, and interest rates are still high, and inflation is still a problem, and all of those, and the rest of the world is still trying to catch up on raising their interest rates, and there's just a lot of risk outside of a window of opportunity for the upside in the fourth quarter of this year. So this points to a breakdown likely going to occur sometime in the next several weeks after maybe some little attempt at rallying back. Let's take a look at the daily chart right in here, and you can see how this now projects. And I want to make a point in here that these upper tracks have now been removed in here, and these harmonics in here were minimally lengthened. We had them at the minor cycle at 11 days, and now we've moved that out to 12. The averages are about 14. The averages are about 12 now. They had been 14 and 14 now these last couple of cycles. So this looks like there's going to be attempted rally early in the week next week. It's come down close to that 78.6%, as you can see right there. And this should be an area that it stops here on this long cycle at 14 days and then tries to move up. But testing the 78.6% means that this next rally will not get as high as this one did. At least the probabilities of that are very low. I will never say never, but it's just low odds. And it's higher odds you'll get a rebound that fails, and then you take out this low again, and the market starts to get sold very hard. This is that daily look at that move down here, and it points to about 3,500 on all of the charts on the S&P 500 out into July, though it doesn't have to be that deep, because this next cycle over here that goes out into late August or early September may be the time that you get it down to 3,500 or maybe 3,200 even. So there is a lot of potential risk. This yellow oval period is really the time when the greatest risk comes. As you see, looking in here, each of those yellow ovals has brought you those big declines. So there's a number of weeks you could get some choppiness in here before you really start to get sold again. But in the meantime, the market is showing you the kind of risk that it has. As the decline here in the last couple days has been very severe. Again, we're looking for this decline in here to stop here in a matter of hours or a day, and then try to move up again. But we don't quite know how deep this is going to be, because the market is in a very negative condition right now. Intraday here. Let's talk about the intraday market. I want to go back in here and look at a slide. We talk about our SIR live stream, which is for short-term traders. This is yesterday. This is on Thursday, and I want you to get the example of what we're looking at in here. Intraday analysis for short-term traders. You get support, resistance, acceleration zone, and the reversal scout, which is this line. Basically, when the line is moving down, it tells you the highest probability is the market will be in a negative trend. These, when it gets through these supports into a yellow zone, the odds are very high it's going to go all the way through the yellow zone. So this is your acceleration areas. And look at 1, 2, 3 acceleration areas in that huge decline. Reversal scout kept you in the right direction. These levels here told you it was likely to accelerate down in a very big way. Here was a little blip in here that might have caught you on the Russell, but then it turned down again in that acceleration zone. So you can get a very good idea looking at that as to the value of using our SIR live stream, stock index report. I actually want to show you this live right now because I want you to see where we are today in this market that's moving down very sharply. So this is the SIR live stream. We're broadcasting this live right now on the askSlim website. And you need to be a level 2, 3, or 4 member. If you didn't see the explanation of this that Arvi did just before because you scrolled forward or you're watching the clip on YouTube, go back a little bit and you'll be able to see Arvi really explain this in a lot of depth. Again, we're looking at the S&P 500, the NASDAQ, and the Russell. This is that reversal scout from yesterday coming down through and where we opened up today in all 3 of the indexes. And you can see it has been negative and telling you going down through these acceleration zones right in here, and now getting down towards an area where it could likely get some support as it has moved down pretty sharply. That's around 3,900, as you can see there on the intraday. The bottom of that there is around 38.88. So that's an area where it very well could get some support today, as the S&P 500 has actually given up as much as 115 points at the low today. But you can see in here how it plunges down through those reversal scouts, with the reversal scout guiding you through those acceleration zones, and again, just barely getting into some support right now that you can see. So this is has been very negative for the last few days, and continues to give you that. We'll be looking for the reversal scout to give us an upturn, to give us some sense that the market has bottomed in there. So I wanted you to see this live. This is broadcasting right now live, and you can see the stuff moving on there as everything is changing. And you can have this by becoming a level 2, 3, or 4 members. And make sure that you write to Matt at askSlim.com if you've never been a member and you want to take advantage of that special. So this again is that short term, and looking at the daily chart, we expect to get this upturn in here, which the reversal scout will tell us on that 15-minute chart, at least give us a hint of that, and then likely to get some kind of a bounce into next week. But again, there are real signs that this is much, much worse. And again, we removed those upper brackets and we slightly expanded this out by 1 click, as the market is proving to us that it is lengthening out these cycle patterns. So those of you that are our members, you of course understand that. And this could even go to 13 and 39 over here if these downside moves do continue to stretch out. Like you see right over here, rectangle broke down. That was the hint down in this corrective phase, and now we should get a bottoming here right around that 78.6% right over there. Remember, I showed you 38.88 on the 15-minute chart. This is around 38.85, so it's very close. And that would be a spot that would make sense for the market to be able to hold in right now. If it breaks under that and threatens this low over here, and that's at around that 38.08 number, that would be really bad. And the market could be in just total free fall if that happens moving forward over these coming weeks. That is a look at the S&P 500 multiple time frame analysis, and a look at our SIR live stream. That is yesterday, as we showed you, and I hope that you found that fantastic. That's it for this show today. Make sure that you go to askSlim.com, become a free member, or take advantage of one of our first-time specials. On YouTube, subscribe to our channel, click that notification bell, and like this video, give us a thumbs up, and watch our member videos in the playlists over here on YouTube, and that'll give you some good sense about the kind of things that we post. And on Twitter, follow us at askSlim. Write Matt at askSlim.com for our membership info and questions on our huge offerings of education and analysis, and our first-time specials, deals that we give for people to be able to really get a good sense of what we bring. I want you to be so careful. It is so crazy out there. I'm always wishing you great trading.
Well, I'm going to